Yeah, so like Ryan said, is this has been I've seen it for probably the past 6 months to a year online, effectively any place which stocks are discussed quite constantly. It's been very topical. So and they've had a big change over the past couple of weeks, so we'll look into that. But if you're unaware, HIMS and Hers Health, symbol HIMS or HIMS on the New York Stock Exchange, operates a telehealth platform that connects consumers to licensed professionals. The company offers a curated range of prescription and non-prescription products on or prescription products on a subscription basis with a focus on personalized healthcare. The company serves four core specialties: sexual health, dermatology, mental health, and the topical one being weight loss. As a whole, since the launch since 2017, the company has really staged itself as a disruptor of the traditional pharmaceutical and healthcare business as a whole, and they now service actually over 2 million subscribers. So it's really been that growth story to that subscriber count over the past couple of years. So if you want to liken them to another industry, it's that Uber disruptor model, high growth rate at a lower cost, and really that consumer focused mentality for at least their past 7 year history. But the stock has performed extremely well over the past year, up 187% to 42.17 at the time of writing, and that comes out to $9 billion in market cap. Despite they have fallen recently from its all-time high of a whopping $73 after the company aired a very well-received Super Bowl ad. For the most part, at least as far as the stock price goes, there were actually some criticism behind the scenes, which I'm not going to get into. But the stock fell recently due to the removal of GLP-1 drugs from the FDA shortage list. The branded versions of GLP-1 drugs include Ozempic and Wegovy, with the active ingredient being semaglutide. The company has offered compounded semaglutide since May of 2024 with accelerated growth for high demand, but in short supply treatment. But now that has changed with the FDA now removing on February 21st from this the semaglutide from its short supply list, which corresponds with that large drop in the stock price by about 50% the day after, or the couple days after, I should say. Effectively, this means HIMS will no longer be able to offer the GLP-1 copy drugs in the near future, with the company stating that semaglutide is not to be offered on the platform after Q1. But they said also as well, if it does go back on the list, or if they can legally offer the compounded variants of the drugs, they will. But at this time, that doesn't look to be the case. And this wasn't actually unexpected. People expected it to be removed off the short supply list. That is expected whenever something does go on the short supply list. Once supply comes back on, it gets removed. And that was a major growth driver within 2024. It really was only just 2024 for it. It wasn't 2023. HIMS itself brought it, the GLP-1 copy on to their platform in 2024. But it was really that big boost in 2024 that it provided, that the GLP-1 provided. And it was expected really that party to end, just not exactly when for the GLP-1 drugs. Further, the other concern I would really have is their reduced ability to cross-sell going forward, as the cheap GLP-1 offerings, which it was about $165 once they, at the most recent offering time, it came on at, I think, $199 onto their platform, but they're no longer offering on the case, compared to Ozempic being around $1,300 on a monthly basis. So $1,300 compared to even less than $200. That's a big difference. And that was really the big selling point of their compounded drugs, is just how much cheaper it was compared to the branded variant. And they're no longer able to do that. The company is, however, expected to, and they are still expecting to offer their oral-based weight loss solutions, as well as generic liraglutide later this year, which is a daily injectable instead of weekly, and generally has been less effective than semaglutide. But the trade-off is that it's still going to be a couple $100 a month compared to the well over 1,000 the branded semaglutides. So your trade-off is less effective, but at a fraction of the cost effectively, and it's not as convenient as you do have to do daily injectables compared to weekly. So it's not as consumer friendly as it previously was with the compounded semaglutides. Switching pace to the most recent financials reported on February 24th, so a few days after the shortage removal. For the year, the highlighted operational metrics: subscriber count grew 45% to 2.2 million. Monthly average revenue per subscriber grew 38% to 73%. Net orders increased by 22% to 2.8 million from 2.3 million, with average order value rising 63% to $168. High growth across the board, but the average revenues per subscriber will be a bit elevated compared to likely the future, as the semaglutides are more expensive than the company's other offerings, which are normally $35 to $55. So, and then the other aspect that actually did increase that in HIMS' favor was the increased amount of personalized treatments, which does come at a premium. But going forward, you will likely see that drop down as the semaglutide craze, which they can no longer offer, will lower their average selling price as well as their average revenue per subscriber. So for the year, the company's revenue grew by 69% to 1.5 billion from 872 million. And when excluding GLP-1 offerings, revenue grew by 43% to 1.2 billion. So still great growth, but just not as great growth once you remove that impact. Gross margins came in at 79% compared to 82% in the prior year, primarily due to the GLP-1 drugs being priced strategically to attract customers. And that really comes into my previous statement of that cross-selling could drop because they were really using it as a halo product more than anything, as well as it was profitable, I should say. Adjusted EBITDA grew substantially to 177 million from 50 million, with an improved margin of 12% compared to 6%. The company posted its first year of GAAP profitability, with all 4 quarters being GAAP profitable, with 53 cents per diluted share compared to a loss of 11 cents in the prior year. Similarly, free cash flow also grew substantially to 198 million from 47 million. Overall, a very strong year, and that's been well reflected in the stock price. The balance sheet as well, very strong. Cash and short-term investments of 300 million and only minor lease liabilities with no other substantial debt. So great balance sheet at this time, no debt, and they've been using it to acquire some additional companies and facilities. Shifting to guidance for 2025, the company expects revenue of 2.3 to 2.4 billion, implying growth of 56 to 63%, with adjusted EBITDA of 270 to 320 million, 12 to 13% EBITDA margin. The guidance does not include any commercial offerings of semaglutide, so whatever amount they are able to sell within the year, it's not included in this, so there is actually potential upside to the guidance if they either have great Q1 sales or down the line if it goes back on the shortage list or some variation of that. So far, I've been pretty positive on the company's operations, but let's take a look at the valuations. Using the company's midpoint guidance, the stock trades an EV/EBITDA on a forward basis of 29.5 times and a price to sale of 3.8 times. So a premium valuation, even with the high growth continued to be forecasted. The company has a target of 10 million subscribers over the next 5 to 6 years, and the current valuation really puts weight on that target. If you do a discounted cash flow and stretch out, which is a stretched out variant of a ratio, you can see that it does rely on having these high 30-40% growth rates being continued for the next decade, really. So concluding, this is really that classic growth stock scenario of where it does still have strong underlying operations with this in respect to its historic growth, but the main bull-bear diversion or division, that is the word I am looking for, is if growth can continue at such a high rate. The stock is traded at a premium and continues to be, but is this premium overstating the growth prospects going forward? I would say that the company at the current price does not offer really a margin of safety. Yes, the company does have the liraglutide products, but also you're likely going to see some GLP-1 users not willing to switch. Some will, but some won't. They won't want to do the daily injectables, and they are willing to pony up the $1,000 or $1,300 a month. Some of them will want to just stay on the $200, which isn't as effective, but we'll have to see really how that affects. And then the other aspect is the degree of the halo effect, which the GLP-1 treatment really was bringing in. That Super Bowl rush in the stock price, you saw that people really putting weight on it being a weight loss halo product. Now, is that going to be the case going forward with the entire platform? Are they going to be able to cross-sell with the alternatives? Maybe not, maybe so. We'll really have to wait and see. So at the end of the day, we are GARP investors, growth and reasonable price investors. And while HIMS may have the growth, it doesn't really seem to have that reasonable price at this time. It doesn't offer enough margin of safety. So we will continue to monitor the company going forward.
Yeah, I think it's a good point. It probably has to continue to grow at 30% plus there, going forward for at least 3 to 5 years to justify the valuation. The other thing that I would point out there, and I think you already did point it out, is the margin, adjusted EBITDA margin is, 12% or so, 11, 12%. So it's not a high margin there. And I wouldn't expect it to ever be. It doesn't mean we can't invest in it. It does have it has a solid balance sheet, and it does have the ability to grow sales over the long term. It just has to grow those sales. It has to be at a high rate. And if anything, hits that, as you can see, you had a little nick in the long-term plan or the long-term growth prospects with the GLP-1 situation, then it gets hit hard. So it may get hit hard and come down to a range where you're looking at it and saying, oh, this is growth, yes, which it is now, and it may become a more reasonable price, and then maybe we could be a buyer of a company like that. But at this point, it's growth, but the price isn't reasonable enough for us to take a stab and invest in the company at this point.
Yeah, and on that margin point, I do believe management is expecting margins to improve to, I think, between 20 and 30% over the long term. But that's decades.
That would be a lot better. Yeah, that would be a lot better if you could get to that.
Yeah. Incorporated in these high valuations at this time.
And
that's the whole bull case of it is you still have that 30-40% revenue growth, and then you get that margin as well.
They still have to actually do that.
Right? Of course. If you could get that,
what if they don't achieve it?
If you get a reasonable price, growth, and an uptick of margins over time, like going from 11% to 20 plus, like if you could do that over the long term, you'd have earnings growth from organic revenue growth, and then you'd also have a margin uptick that can provide earnings growth, and you'd probably you can sustain a higher margin on the stock. But right now it's pricing all of that in. Certainly when it was at $70, it's pricing everything in to perfection. That doesn't give you any margin of safety, and it's that combination is too high risk. It may be a company that we look at. If this is a weaker market over the next 6 months to a year, there can be some companies that you see long-term growth in that you may want to buy, and it could be half the price or less that it is today, and that may be a time to buy.
Yeah, and just even going back just on the stock price volatility, if you just go back to the start of the year, it was $26. That's still a 30% discount from where it's at. And if anything, with the GLP-1 scenario, is really the outlook in the short term, at least over the next year, is decreased.
Yeah.
So
So
it could be there. Stocks, my point.
It wouldn't be, it doesn't say it's going to go there, but it could be there. So you put it on your monitor list and you have a valuation that you think is the intrinsic value going forward. And that's what we'd be doing. If it goes significantly below what we think intrinsic value is, then it could be a buy. And we have a US small cap related service that this would kind of fit in there, roughly in that category, that we would then look at for inclusion there. It's dropped below the $10 million market cap, so it's $9 million. If it comes down significantly, it's kind of in our wheelhouse, and it may be a company that we'd look at. It doesn't have the margin of safety in terms of valuations right now that we'd like to see.